Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Tuesday, October 26th, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Futures currently are up again. It does look like we're going to see potentially another record high on the Dow Jones, which is now up more than 120 points. The futures are up just over 120 points. S&P 500 futures up about 20. NASDAQ futures approaching 100 points higher. So it does look like we're going to get off to another good start. Historically, this is a very difficult time during the year, but and we've got negative divergences everywhere, but the market doesn't care. Right now, we are in a secular bull market advance and currently just looking for higher prices. So looks like things are going to get off to a pretty good start, and then we'll go from there. Taking a look at today's agenda, going to go through that daily market recap with you, talking technically. Then we're going to break it down, going to break down a sector for you, go into the industry group level, find the best industry groups, and then take a look at some stocks within those industry groups. Then we'll get into our earnings spotlight and wrap it up with the 3 you must see. But before we get into any of that, let me take you over to earningsbeats.com. If you go over to our website and then simply scroll down, you will find an area to subscribe to our free EB Digest newsletter. This is a newsletter that I publish 3 times a week, Mondays, Wednesdays, and Fridays. Typically, they're out by about 8:30 a.m., so maybe an hour or so before the market opens. It's normally a very brief read, just a couple of paragraphs, one chart, and it just gives you an opportunity to take a look at how we view the market and the way we look at trading opportunities. There's no credit card required, so you can simply type in your name, email address, hit that subscribe button, and you'll be good to go. You can unsubscribe at any time, but I think you're going to find it's a very educational newsletter and potentially could set up some nice trading opportunities for you as well. All right, let's move on. I want to take a look at what happened on Monday to start this week. As I mentioned, this historically is a rough week from the October 21st close through the October 27th close, which is tomorrow, Wednesday, the close tomorrow. That 6-day period has been the worst period of the year historically on the S&P 500 since 1950. But this year doesn't seem to matter. Right now, we've got the market in breakout mode. And, I always say seasonality, it's a great indicator. I love checking out seasonality to give me some additional clues about market direction or individual stock direction. But nothing is more important than actual price action. And right now we are in breakout mode. The technicals outside of the short-term 60-minute negative divergence, I think technicals look good. Going to keep watching for leadership, make sure the right groups are leading. And we'll talk about that a little bit more throughout the show. But you can see on Monday, we had the Dow Jones Industrial Average up 64, S&P 500 up 22, NASDAQ up 136 on a percentage basis, climbing 0.9%. There was your winner among the major indices. Mid caps, though, up about 0.5%. Small caps up not far behind the NASDAQ, 0.85%. So not too far from that 0.9%. But small caps making a breakout above recent highs. Very important. And look at the AD line strengthening here on the small cap index as well. So really great action. And across all of our major indices, look at the AD line once again coming up to confirm the price action that we've been seeing. Now, at a sector level, this was another big day for discretionary stocks. Consumer discretionary was up almost 2.5% yesterday, just a huge day. Look at that volume coming in on the XLY, AD line turning back up. Energy and materials also had strong days. Energy up almost 1.5%. Materials up 1%. Then to the downside, we had utilities down a little bit more than 0.4% after breaking out above the 50-day, still holding that level. Financials down just barely, about 0.1%, and in this uptrend. So a little bit of profit taking there, no problem at all. Moving on to the 10-year Treasury yield this morning. Still just a little bit too early to get the latest, although I can probably tell you what's going on here. Yeah, actually, 10-year Treasury yield down a little bit. We had a reversal move down yesterday. I think that was part of the problem with the financials. And now it's down about 2 basis points this morning to around 1.61%. So we may see more selling in the financial area on a relative basis, given the initial drop here in the 10-year Treasury yield. We'll see whether that holds up. But we remain in the uptrend. 175, I would say, is that short-term target, 1.75%. To the downside, watch that rising 20-day. Right now, that seems to be your key support. And if we fail to hold it, I think maybe the 50-day back down close to 1.4%, something like that, could be in the cards. That would not be good in the short term for the financials. And I don't believe we're going to go back down there on the yield, but a move back down to test the 20-day wouldn't really be that much further. All right, let's move on. Do want to let you know before we get into that next segment that from an economic standpoint, there are a number of economic reports coming out today that could affect the bond market and the stock market. The August Case-Shiller Home Price Index expected to rise 1.3%. July rose 1.5%. So a little bit of a slowdown there. The August FHFA House Price Index also expected to rise 1.3%. July also, actually July was up 1.4%, so a slight difference there. So both of those housing reports, we're looking for just a slight downtick from what we saw in July. September new home sales expected to come in at 760,000. August was 740,000. So this one, we're actually looking for a little bit of a step up, little increase. And then finally, the October Consumer Confidence Index will be out. September was 109.3. October expected to drop slightly to 109.0. So lots on the economic docket later this morning. So be sure to check all that out. Of course, earnings coming in really starting to pick up here over the next few days and into next week. Just going to get a ton of earnings reports coming out. So it's no longer, rumors and so forth that's driving the market. We're going to get some actual news, not only on the economic front, but on the earnings front that are going to help us determine which way we are heading. All right, let's move on to talking technically. And I just wanted to, I ran through just a ton of negative divergences in my blog article on Trading Places from Saturday. So be sure to go back and check that out. I can show you over here under articles. It's this U.S. equities have one very serious short-term problem. Just a ton of charts showing negative divergences. So go back and take a look at those. But market doesn't seem to care, and the market can do whatever it wants to do. So we'll see what happens today. We'll see whether or not over the next couple of days we get any selling whatsoever. But you can see the S&P 500, that PPO on the 60-minute chart, still much lower, even though prices continue to try to push higher. I wouldn't be surprised. Maybe there's going to be some kind of a big event, maybe a big earnings miss, something over the next 24 hours, 24 to 36 hours, and give us a pullback potentially down near that 50-hour SMA. We're only talking about maybe 1%. It wouldn't be a huge drop, but that would help to relieve the short-term momentum issues that we're seeing. But as I mentioned, market can do whatever it wants, even when we see technical issues. To me, technical analysis is all about determining your risk and managing risk. It has nothing to do at all about trying to guarantee some sort of a move in one direction or the other. It's not why I use technical analysis. It's not about guarantees. And it's why, quite frankly, a lot of folks who don't believe in technical analysis don't believe in it because they always point to things that don't work. Well, I can tell you right now, things are not going to work, not 100% of the time. And so if that's your bar, if that's where you're setting the bar, then you're not going to believe in technical analysis. Technical analysis is simply the study of prior price action to try and give us a little bit of help in what might be coming. And that's it. And you can manage your portfolio accordingly. It is not going to provide you guarantees. But let's keep going. I wanted to talk a little bit about consumer discretionary. Here was the breakout. We saw this just a couple of weeks ago. I've been very, very, very high on the consumer discretionary sector. Here is the breakout in absolute terms. You can see the AD line, not quite broken out. We'll need to watch this, make sure we get that to confirm as well. But it's certainly not going in the wrong direction. It's just kind of going sideways here. Need to get that breakout there. But the PPO looks great. And this move to the upside, very strong as well. On a relative basis, and this is the reason why I've been so bullish on consumer discretionary. If you look back at history, this is the last 10 years. It was April of 2013 when we broke out above the S&P 500 highs, the tops that were set back in 2000 and 2007. 2013 in April is when that S&P 500 those tops were taken out. That to me was the signal that the secular bull market was underway. Not 2009. Nobody knew in 2009. You can go back with, Monday morning quarterbacking and go back and say the bull market started in 2009. But there was nobody holding up a sign in March of 2009 saying the bottom was in. So to me, the more definitive date was in April of 2013 when we took out those previous highs. Anyway, since then, we've seen the aggressive sectors doing very well, but they don't all go up on a relative basis at the same time. The XLY goes through these periods, and you can see these just massive relative strength. This isn't the XLY. This is the XLY relative to the S&P 500. So if you're trying to beat the S&P 500, when the XLY is in one of these runaway moves to the upside, you want to be in. This is when you can outperform the S&P 500 by being in consumer discretionary. Well, if you look at history and you look at the relative PPO, again, this is the PPO of this relative price action. When the relative PPO goes into negative territory, which doesn't happen very often because the XLY tends to lead during secular bull markets, but occasionally they'll underperform for a period of time. When you get to that -1 level, I've drawn the line right across here. Just check out what happens. I'm not making anything up. I'm just pointing out what's happened on the charts. Again, prior history. So here we got to -1, and look what happened. We struggled for a little bit. We did on a relative basis go slightly lower a few months later. But that bottom right there, when we started showing relative strength and strengthening momentum, this is what we got in absolute terms on a relative basis. Huge outperformance. What happened the next time we got down to -1? Well, we came up just short, but looks like we may be down to -0.9, something like that. Anyhow, from there, back up, a huge move on a relative basis. Here, got this double bottom, similar to that double bottom and similar to the double bottom we just experienced. But this down at -1, what happened? Consumer discretionary took off. Each time in the prior 3 cases, we've gone up to take out these prior relative highs, breakout, prior relative highs, breakout, prior relative highs, breakout. So coming off of this, here's your prior relative high. We're not even there yet. So this is one of the reasons I've been talking about consumer discretionary here in the 4th quarter. I think this is going to be a huge quarter for discretionary stocks, and we are making that run. So with that, perfect lead in to the break it down segment. So in the break it down segment, I want to take a look at consumer discretionary. I want to break down the group. So you could trade the XLY, but what if you want to go inside discretionary and start looking for individual stocks? How would you do it? Well, I would first go into the relative charts of the consumer discretionary group relative to the S&P 500. So let's pull up the discretionary groups and take a look here. So we start off with hotels. Yeah, I mean, definitely got to move up, but we've been pulling back. I still like the group. I just don't know that this is going to be a leader in the 4th quarter. I think the group's okay as long as we stay above these relative moving averages, but already starting to roll back over, and we've seen this before, so I want to be a little careful. Let me point out the ones that I like. I'm going to start off with the home improvement group. Here, you can see clearly that we are moving up into the fourth quarter. And watch this. I mean, we could be breaking out to a new 3-year relative high in the home improvement group relative to the S&P. So that group looks really strong to me. How about specialty retail? Specialty retail had a huge move during the initial stages of the pandemic and then tailed off for about a year and now is coming back strong again, really moving up rapidly on a relative basis. This is a group I want to keep an eye on. Furnishings has actually cooled off. And you can see after the huge move, we've pulled back. I'm just kind of watching this because if we can get a move back up through the 20-day, the relative 20-day moving, or excuse me, 20-week, relative 20-week moving average, I think that would be potentially a kickstart here in this group. So that's a group that I'm at least keeping my eye on. Footwear. Footwear has been volatile, and you can see a huge move up, huge move down, huge move up, huge move down. Starting to move back up again. The one thing I'll say is we've got higher relative highs, higher relative lows, that relative PPO turning at the center line. We're back above both moving averages. This is a group that could run in the fourth quarter. 2 more to go. One is the Business Training and Employment Agencies Index. This thing's been a steady performer now for a year and a half. It's pulled back recently on a relative basis, probably providing us some opportunities. And then the last one, and this group is on fire right now and carrying the consumer discretionary space, automobiles. Tesla is flying. And as a result, the automobile group relative to the S&P is just turning straight up. And we've seen what happens when the autos get going. Huge move up, pulled back, consolidated for several months. Looks a little bit maybe like a relative cup, but I expect more out of automobiles here in the fourth quarter. All right, so now we've got, 6 industry groups. And so I'm going to give you some individual names within these groups that I think are interesting. I'm going to start with Floor and Decor Holdings. Now, many of these stocks, if they haven't already reported earnings, are likely getting ready to. So make sure you check earnings dates and that you're comfortable owning any stocks into their earnings if you so choose. That is the riskiest time of the quarter to own a stock, is right into its earnings report. Anyhow, in the home improvements area, Floor and Decor Holdings just recently made another breakout. Volume picked up on that, took at that high. And you can see on a relative basis, stock's been pretty good coming off of this relative low back in May and June. Went up, put in the double, triple relative top. We haven't been able to break through that. Established what looks like maybe a double bottom. I think overall, though, this is a pretty strong stock within a strong group. So this is one I'd keep an eye on. Lowe's, just really looking good. The AD line is the one that's bothered me a little bit, but it's starting to turn up. Look at all these hollow candles. Seems to be a lot of accumulation taking place. Relative strength pretty good. And then Home Depot. If the AD line concerns you on Lowe's, you might want to go with Home Depot because this one's breaking out. Same type of move to the upside. Lots of hollow candles. Relative strength was weaker, but is starting to pick up. It's been going kind of sideways with a strong group of late. But I like those 3 in the home improvement area. Then we've got specialty retailers. Let me give you a few of these. Dick's Sporting Goods, DKS, broke out this huge gap up, continuation gap. We went back into the gap, didn't quite fill to the bottom, got close though. Now we're starting to turn back up again. I suspect we're going to move to new highs. AZO, this is AutoZone. AutoZone just recently breaking out. That one you can see the AD line very strong. AutoZone looking good. O'Reilly, another AD line looking good. Just recently broke out. O'Reilly looks good. Tractor Supply, TSCO, got this little cup here. So you got a nice move up, little cup, maybe a handle forming. A breakout above 215 would measure up close to 240. Keep that one in mind. AutoNation. I mean, this thing's been volatile, pulled back down here to this low around 102, 103, had a huge move up to 130, pulled back down to in the 113, 115 area. And then with earnings, has broken out above the 130 level. Now, the AD line going to 11-month low. Yes, that's a little concerning, but the stock has been showing pretty good relative strength. I just think when I see a negative or a poor AD line, I just want to make sure I can keep my stops fairly tight. So I wouldn't chase. I'd be looking maybe closer to some gap support or the 20-day, something where I can keep my stop a little tighter. Otherwise, maybe look for a different stock in the space. One stock I mentioned recently in the daily market report, National Vision Holdings, EYE. This one had moved up with solid volumes, pulled back. That gap support in the 20-day moving average, though, holding at this point. I suspect we're going to go back up and challenge that 64 level. Let's move on to the furnishings area. And within furnishings, I'm going to pull up TPX. So this is Tempur-Pedic. Tempur-Pedic, huge move up, pulled back, but now starting to strengthen again. Looks to me like a cup. So I'd be looking maybe for a move up to 50 to finish that cup. Watch the rising 20-day to the downside as your support. Lovesac Company, LOVE, was trending lower for about 3 months, June to early September, but now we're trending back in the other direction. Good volume trends, 80 line picking back up again. Seems like it wants to move back up toward that 90-92 area over time, and that's what I'd be looking for there. In footwear, Crocs. Crocs looked like it was breaking down, but notice had heavy volume, had this gap support, went down into the gap area, held there, and now we're right back up near new highs in just 2 weeks from those recent lows. So Crocs looking pretty good. Shoe. This is Steve Madden, just broke out to new closing high. Volume trends here definitely have started to turn to the upside. So this is one that's been consolidating for a while. But we get through that intraday move, get above, close above 46. This one is one that could take a run and start to move on a more consistent basis to the upside. Nike, after moving down into its gap support zone, has turned the ship right back around, now trending higher. It looks like we're about to get that golden cross, the 20 over the 50. I think Nike looks good. Last one is Deckers Outdoor, DECK. Deckers also downtrending, holding on to prior support, now moving back up above the 20-day. This one doesn't look quite as good as the others, but it did like that consistent volume coming in off the bottom and going through the 20. I would want to see the stock holding its 20-day from this point forward. So that's something to watch for. How about business training and employment agencies? Well, some smaller stocks, but NSP just broke out again, AD line strengthening. You look at the relative strength, it's just moved to about a 9-month, maybe 10-month relative high on NSP. So this one looking pretty good. That's Insperity. Another one, TNET, which, by the way, just reported earnings. I believe it was last night after the bell. They absolutely scorched earnings. Earnings were expected to come in at 82 cents. They came in at $1.31. So not even close. And the stock was up in pre-market 5.6%. But this one's pulled back to a key support area, the 20-day, the 50-day. AD line's been strong. Now we're getting that almost 6% move to the upside, which is probably going to be a breakout on the open today. This is another stock I think looks very good within that space. All right, let's take a look at automobiles. Clearly, Tesla. I've been saying this is one of my favorite stocks, if not my favorite stock in the market for a long, long time. I've also gone on record multiple times and said, if I had to hold a stock for 10 years, if I had to, forced to, Tesla would be my pick. I just think that this is a company that is it's in the sweet spot of where things are just heading, and it's a leader. So I look for the company to just continue to do extremely well. I know Kathy Wood, who's a portfolio manager over at ARK Funds. She's a very big bull of Tesla. Says she believes 3,000 on Tesla in the next 4 years. I would not dispute that at all. I really believe that I've said in the next 5 years, I think it's going to overtake Apple, Microsoft, and I think it'll be the most valuable company in the world. That's my opinion. We'll see what happens. But Tesla, the biggest reason why we're seeing the automobiles doing what they're doing right now. There are others, though. And LI, this is Li Auto. This top right in here, double top 35.36. Let's watch that. We're making a move. AD line is already threatening a breakout over these prior highs. So I think LI is setting up for a breakout here. Race is one to watch. This is Ferrari. Look at this move, breaking out above these prior highs. We got a little bit of overhead resistance from back in December, which we just tested, but we are on the verge of breaking out of a sideways consolidation period, a lengthy one, a very solid long-term base here. So I think Race could be a very strong play, but I'd like to see that breakout. And then the last one I'll bring up is NEO. NEO just starting to move again. This is one that can really move in a hurry. We saw a move in May from 31 to 55. That was in 6 weeks. We know what happened a year ago in November. Huge move to the upside. Maybe we're starting that same type of move. NEO is much more aggressive, certainly more volatile, probably not for a lot of investors who are, can't afford to lose capital, because you got to take some risk with NEO, but there's also the potential for a big reward. So it just depends on your trading style and, what you're looking for. But NEO is starting to gain strength, and seeing what Tesla's doing, breaking out to all-time highs, that gives me some pretty good feelings about this stock going higher. All right. Going to have to go through earnings fairly quickly here, but I want to just point out a couple of stocks that are doing well, big names and big moves. Facebook, let me give you the update here. Where are we now? We're up 1.25%. I don't know. Looking at this chart, a little bit of a gap up. This could just be a temporary move, another move lower. I'm not really feeling it right now on Facebook. They beat by 2 cents, 32 cents, or $3.22 versus $3.20. So a beat, but not a big one. One company getting a big reaction to earnings is Medpace Holdings, MEDP, up 6% to $200. You can see that clears all of this overhead resistance. This is a stock that looks good, but we never know with that gap up. Is it going to continue going up, or is it going to pull back first? That we'll have to see. There were 3 companies that reported this morning, and these will be the 3 you must see. So let's go ahead and wrap this up by combining earnings with the 3 you must see. First up, United Parcel Service. I have not actually, I saw headlines that they had beaten their estimates on the bottom line. That's all I know, but a big reaction so far this morning on UPS. This is a stock that earnings beats folks know that I'm a big fan of. It's in one of our portfolios. Also wrote an article about it. The stock loves the month of November, up 19 of the last 20 years in November. So, and we're right around the corner from November. So stock looks pretty good here. Another stock that is not faring quite so well in pre-market is Corning, GLW, down 3% pre-market. I did not see the news, but you can see it's been in a downtrend for a while. I tend to stay away from stocks that have been in long-term downtrends. There's usually a reason for it. And then the last one I'll give you, this is a company that most of you are familiar with, probably heard before. General Electric, stock up 1.3% this morning. They're reporting we need to get through about 108, 109. If we do that, then I think GE can run. Until then, I think we got to be a little careful. All right. Again, just like to invite everybody over to earningsbeats.com. Make sure you subscribe for that Earnings Beats Digest newsletter. That stat on UPS, 19 out of 20 years, I provided that to our free Earnings Beats Digest community on Monday morning before this earnings report came out. I mean, this is a company that definitely was setting up for a big move to the upside. Now, I think it's well underway. Anyhow, everybody have a great day. I'll be back on Wednesday morning over at Trading Places or over at Earnings Beats for your next Trading Places Live. Have a great rest of your day, and hopefully see you tomorrow. Take care, everybody. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.